Are you familiar with a health savings account, an HSA? Would you be able to pass a test on it? Well, here to talk with us about HSAs and everything you need to know about them is Dana Anspach from Sensible Money. Dana, welcome.
Thanks, Bob. Always fun to be here.
It's always great to have you. It's always great talking about various topics with you. And this one is particularly interesting to me, and I'm sure a great many others. So let's start with the basics about what an HSA is and whether everyone can have one or not.
Yeah, absolutely. So an HSA stands for Health Savings Account. And in some ways, it's similar to an IRA or individual retirement account in that you get a tax deduction when you put money in. But in many ways, it's even better than an IRA because you can allow the funds to grow tax-free and withdraw them tax-free when they're used for a qualified healthcare expense. So because of this, sometimes I hear them called triple tax-free. Now, there are some differences with an IRA. You have to have earned income in order to be eligible to make an IRA contribution. With an HSA, that is not the case. You do not have to have earned income. However, you must have a qualified high deductible health care plan in order to be eligible to make an HSA contribution. And your insurance plan will be able to tell you if it's HSA eligible. The other downside to the HSA is that you can't put a whole lot in. So the maximum contribution limits for 2021 are $3,600 per person. That's if you're age 54 and younger. If you're age 55 or older, you can put an extra $1,000 catch-up contribution in. And if you have a family plan, so you're the primary insurer and you have a plan that covers your spouse, you can make contributions for both of you to your HSA account. But if your spouse is over 55 and you want to make that catch-up contribution, then they actually have to have their own HSA account to be eligible to make that catch-up contribution for them.
Right. So they sound great on paper. Do a lot of people use them and do a lot of people fund them? And can they fund them forever?
Great question. Well, first off, not everyone uses them because not everyone has the high deductible health insurance plan, so they're not qualified. But there are many people that do have the right plan and they could take advantage of the HSA account and they don't. One reason, I think people may have this misconception that the funds are use it or lose it, the way the flexible spending accounts work, but that is not the case with the HSA. You can contribute and let those funds accumulate, grow them tax-free. They are yours, so you don't lose them. If you change your employers, your HSA funds are yours and they remain in that account until you use them. Now, one of the other downsides, you can only contribute to an HSA until you enroll in Medicare. So for most people, that means no more HSA contributions once they reach age 65. In the year you turn 65, you can actually prorate your contribution for the amount of months that you were not on Medicare. And for some people, if you're in a situation, usually if you work for a larger employer, so you're not required to enroll in Medicare when you turn 65, then you would be able to continue to make your HSA contributions until you did enroll in Medicare. But unfortunately, you can't make those contributions forever.
Right. So I recall when the HSAs were first introduced, they were described as IRAs for healthcare expenses in retirement. How do you typically see people using HSAs?
Yeah, so what most people do is they put the money in and then they use them throughout the year. So they may have a copay that comes up or, a portion of their deductible or an expense that isn't covered by their health plan, like dental care, a crown or dental cleaning, or certain types of over-the-counter prescription medications can even be paid out of your HSA. But using them throughout the year is not the only way to use them. So you can invest the funds in your HSA and actually let the money grow tax-free for many years. At age 65, you can take penalty-free distributions for any reason, just like with an IRA account. The distributions will also be tax-free when they're used for qualified healthcare expenses. And some of the things that qualify, for example, are anything that covers your Medicare premiums. So your Medicare Part B premiums, a Medicare supplement or Medicare gap policy, you could pay for those with an HSA, even your long-term care insurance premiums. Now, for most people, once you're collecting Social Security, your Medicare Part B premiums are deducted right out of your Social Security check. So you could even withdraw the funds from your HSA to reimburse yourself for those Medicare Part B premiums that you paid. So the option you could do, rather than using the HSA throughout the year, is fund it, let it grow tax-free for many, many years, and then use it to cover some of these expenses that you know you're going to have in retirement. This can be a really effective way to get a lot of years of tax-free growth. They can also be used to cover health insurance premiums when you're unemployed. So you could also use your HSA if you're a little younger as somewhat of a special purpose emergency fund. You could fund it, don't use it. You know it's there just to cover your healthcare expenses or premiums in the case that you should go through a period of unemployment. And there's even what I call a backdoor way to use your HSA funds. So amazingly enough, if you have healthcare expenses, you pay them out of pocket, you save your receipts, and you do not take an itemized deduction for these expenses, then years later, you could reimburse yourself from your HSA for those expenses that you paid previously, as long as you actually had an HSA, had set it up and funded it prior to the time that those expenses occurred. So for example, let's say I get a crown this year and it cost me $1,000 and I just pay out of pocket. I don't take the deduction for it. And years later, I become unemployed and I have my HSA funds. Well, I could reimburse myself for that $1,000. The funds would come out tax-free. And I could also at that time use the accumulated HSA funds to cover my health insurance premiums. So pretty cool.
Yeah, that is great. So is there an age at which you recommend that clients begin drawing down their HSAs?
Yeah, that's a great question. And it's a question we get from clients a lot. There isn't an ideal age to start withdrawing, but the HSAs aren't the most tax efficient type of account to pass along to heirs. So you would prioritize using HSA withdrawals before taking money from a Roth IRA or before taking money perhaps from your traditional IRA. Now, let me qualify that by saying if the beneficiary of your HSA is your spouse, then that works really well. Much like an IRA, your spouse can inherit your HSA and it becomes their HSA. But if you have a non-spouse beneficiary, then the account becomes taxable to them in the year of your death. They can deduct any medical expenses that they had to pay on your behalf, but for the most part, they're going to have to pay taxes on that full amount. So when you put all of this together and you look at the fact that the withdrawals are tax-free if used for qualified health care, the best time to use these funds would be during your highest tax rate years. So if it would lessen what had to come out of an IRA, or if it would mean that you didn't have to realize as much capital gains that were going to fall into a higher tax rate, that would be the time to take funds from your HSA. So let's say you're retired and you are in a middle to high tax rate, let's say 24% federal tax rate or higher, and you've accumulated a pretty large balance in your HSA. You might then say, I'm going to use this to cover my Medicare supplement or Medicare Part B premiums. And let's say those run $300 a month or $3,600 a year. So every year you take that money out to cover that expense. If instead that money had to come from your IRA account, you'd only get $2,700 after taxes. So it would be a more efficient way to use those funds at that time.
Right. And so how do you recommend that people invest their HSA?
This is also a great question and a common one that we get. So what I like to do is leave 2 years worth of my deductible in what I call the low volatility bucket, in something safe like a money market account. And then I invest anything over that amount in growth index funds. So, that's a staple for me. Now, how you invest should really depend on how you plan on using your HSA account. So if you have a sufficient emergency fund outside of your HSA and you want years of tax-free growth, and you wouldn't have to take anything out of that account for at least 5 years and preferably 10 years, then you may invest all of your HSA in growth. On the other hand, if you have a job where it's pretty likely you could become unemployed, then you may want to keep your HSA in a very stable option, a money market or a savings account. It won't grow that much, but absolutely that it will be there when you need it, and it won't be worth less in value if we're in a down market. So really, it's best for you to decide how you're going to use your HSA account and then invest the funds accordingly. For me, I own my own business. And so although unemployment isn't going to happen to me, like a lot of business owners, income can vary a lot from year to year. So I feel most comfortable keeping 2 years worth of my deductible in something safe and stable. And the rest, I'm going to grow. I'm going to let it accumulate for my retirement. For my plan, probably I will start withdrawing from my HSA in my mid 70s once I am claiming Social Security and required to take minimum distributions from my IRA. At that time, my HSA balance should be large enough that I could reimburse myself regularly for my Medicare Part B premiums and supplement premiums. And in the meantime, until I get there, I'm just going to pay my healthcare expenses out of pocket. I'm going to keep those receipts. And that way, if something happened and I needed to take a lump sum from the HSA sooner than I thought, I would be able to do so. And I would be able to reimburse myself tax-free to the extent that it was covering expenses I paid previously.